Good morning. It's Wednesday, the 5th of February, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming, as always, from Mumbai, India's financial capital. The world is focused on US President Donald Trump and what he may or may not do as he negotiates with China. Events are happening so quick that it's tough to catch every move and analyze it and counter-move, for that matter, even in our very short news cycles. As things stand, the US and China have announced tariffs against each other, though there is some method within that madness, so to speak, in terms of products targeted, meaning these are not blanket tariffs, and I'll come to a little more of that. It's likely that the tariffs will be pulled, as it happened with both Mexico and Canada, who've been given a 1-month lease of life. So at this point, we don't know. But today is a special edition and has some news and analysis, but a long interview where I hope to bring you a different but important point of view on why the United States is targeting China and what indeed determines US policy on China, and how this eventually impacts markets and Wall Street and stocks around the world, and more importantly, in India going forward. Now, this is important because the rationale will not change. And when I say rationale, I mean the US-China rationale, even if there is a tactical shift in tariffs or other economic measures that are announced as and when they are. The rationale is important to know because this is how the present administration in the United States will view China, including in the context of DeepSeek, the new seemingly low-cost artificial intelligence model that is creating waves.
This is a Core Report with Govindraj Ethiraj.
And now the stock markets on Tuesday. The stock market saw their biggest one-day gain in a month on Tuesday, mostly not affected by the China-US trade war fears that were pushing down stocks worldwide. There is a positive undercurrent in the markets, as we spoke of yesterday, even though the market was down on Monday. The reasons are many, but one view that is being put forth is that the markets are now seeing the positive takeaways from the union budget presented on February 1st, including that 100,000 crore rupee benefit that's flowed to many taxpayers by way of tax breaks. Of course, with that pause on Mexico and Canada tariffs, that changes the situation somewhat and brings life back to some normalcy, at least on the trade front. The 30-stock BSE Sensex closed up 1,397 points at 78,583, and the NSE Nifty 50 was up 387 points at 23,739. The Nifty Bank, Financial Services, Metal, Pharma, and Healthcare indices were up, and the Nifty FMCG index was the only one in the red, which is interesting given that the union budget was expected to provide a good and strong fillip to consumer stocks. In the broader markets, the BSE mid-cap was up about 1.3%, and the small cap was up about 1.2%. The rupee is up too. The rupee was higher on Tuesday with some swings, similar to the action that was seen across the region. It ended at 87 rupees 6 paise against the US dollar, against a record closing low of 87 rupees 18 paise in the previous session, when it also fell to an all-time low of 87 rupees 28 paise, according to Reuters. So the closing price, 87 rupees 6 paise. The China syndrome. So the tariff wars have begun, at least for now. Beijing has put a 15% tariff on less than $5 billion of US energy imports and a moderate 10% fee on American oil and agricultural equipment on Tuesday, moments after the new US tariffs entered effect, according to Bloomberg. China said it will also investigate Google for alleged antitrust violations, though Alphabet, that's the parent company's search services, have been unavailable in China since 2010. There were also targeted measures such as against Calvin Klein owner PVH Corp and US gene sequencing company Illumina Inc. on a so-called blacklist of entities that could affect their large operations in China. And it also imposed new export controls on tungsten and other critical metals used in electronics, aviation, and defense industries, according to Bloomberg. Meanwhile, President Donald Trump has invited India's Prime Minister Narendra Modi to visit the White House next week, a White House official said, hours after a US military plane departed to return deported migrants to India, according to Reuters. Trump spoke with Modi on Jan 27th when they discussed immigration and stressed the importance of India buying more American-made security equipment and fair bilateral trading ties, and you will hear more on that shortly. Importantly, India has transmitted that it is not going to become protectionist and has already offered some concessions to the US, all of which is good for the Indian consumer. So the general feeling is that India could actually come away with some trade and strategic wins following Modi's proposed meeting with Trump soon. The United States is India's largest trading partner, and two-way trade between the two countries surpassed $118 billion in 23-24, with India posting a trade surplus of $32 billion. The trade wars have begun, at least with China. Why is China on the Trump administration's crosshairs? And from a financial markets perspective, what do these latest developments mean for markets in the United States, Wall Street, Asia, and more importantly, India? How is 2025 panning out in terms of new investment opportunities and themes, both sector-wise and country-wise? Today, I'm joined by veteran hedge fund manager J. Kyle Bass, founder and CIO of Hayman Capital Management, and investment manager of private funds focused on global event-driven opportunities. Bass is a life member on the Council of Foreign Relations and a recipient of the 2019 Foreign Policy Association Medal for his responsible internationalism. Bass is also the former chair of the Risk Committee of the Board of Directors of the University of Texas Investment Management Company, which manages around $65 billion. He used to be earlier a managing director at Legg Mason and a senior managing director at Bear Stearns. He's also an advisory board member of the Hudson Institute's China Center, an executive advisory board member of the George W. Bush Presidential Center, and an investment advisory board member to the RIA New Edge Wealth.
I mean, look, Govind, I think what's very important to understand about this action is last year we lost over 110,000 Americans to opioid and fentanyl overdoses. There is a reverse opium war going on. It's coming through the Canadian and the Mexican border. And all of the precursor chemicals, 97% of the precursors are sent to Mexico and Canada from China. China's a country where they chased one or two COVID cases around the whole country and locked the whole country down. And somehow magically, they can't stop hundreds of thousands of doses, lethal doses, coming into America. Just to be clear, last year on our Canadian border alone, we interdicted 43 pounds of illicit fentanyl from China through Canada. 43 pounds of fentanyl will kill 9.7 million Americans. 9.7 million. Since Operation Lone Star began in the state of Texas, we have collected 350 million lethal doses of fentanyl, enough to kill every man, woman, and child in America. So when you start hearing about tariffs on Canada and Mexico and China, they are directed at one thing. It's drugs. Stop the drugs flowing across our borders. And if you don't want to do it, these tariffs will stick. And so, we have talked and talked and talked and talked. Where talking gets you, it doesn't get you anywhere. And if you're dealing with an authoritarian state, the only thing they understand violence and money. Those are the two things they understand. So guess what? We're coming at them with tariffs because we want the drugs to stop. It's that simple. So when you say, is it going to be a negotiation? It's certainly going to be a negotiation because 25% tariffs close things off. So if Canada and Mexico have half of a brain, they're going to comply.
Right. Okay. So let me come to China in specific now. So the problem of fentanyl is obviously to do with health and healthcare issues. And as you said, it's killing Americans. But there is a larger trade problem with China. And that's something that's been articulated, including in the campaign trail leading up to the most recent elections. If you were to take the danger part out of the equation, in this case, fentanyl, is everything else hunky-dory or fine on the trade front?
We all know that's not true. It's very difficult to isolate specific, this 10% is for drugs, this 10% is for dual-use military operations, or let's just say malign actions in the South China Sea. I guess nothing's monocausal, right? It's an amalgamation of things. I can tell you the tariffs that were instituted or that will be today are very specifically focused on drugs. It's that simple. We're trying to tackle one problem at a time. If you understand the way President Trump negotiates, he said this publicly, he doesn't believe in a multilateral or let's say a multivariable settlement. He wants to go handle individual settlements, individual countries, individual negotiations, because he believes that's how you optimize the negotiation. I tend to agree with him on that. So we're tackling drugs first. We're going to be tackling China's belligerence in the South China Sea, what they're doing in the Philippines, what they're doing throughout Southeast Asia, militaristically. That's coming. But right now we're focused on drugs. And so if you're asking about kind of the rest of the relationship or as it relates to trade, we do about $600 billion of trade with China annually. We're about a $30 trillion economy. I think people errantly believe that we can't do without China. We can certainly do without China. We have a great relationship with India, and it keeps getting better and better. We have relationships throughout Southeast Asia. India is the world's largest democracy. I believe the primary issue with India, this is my opinion, is we need to get your defense capabilities away from Russian equipment and into some sort of Western equipment. And then I think, India will be in a much better place. But, that's going to take some time.
India has made the first move amongst many other moves in the past to reduce duties on Harley Davidson bikes. So, which has been a sore point of sorts with President Trump from his previous administration as well. So things are moving on that front. But let me understand your views on China a little more. So you've been speaking on this subject, and I guess over the years, why is it so much of a concern for you? And in the context of trade, in the context of, let's say, something more recently like DeepSeek and so on.
If you look at the primary objective of Xi Jinping and the, call it, ruling elite in the Standing Committee of the Chinese Communist Party, they've been telling us since 2017 that they have a few goals. Number one is global primacy at any cost. Number two, he will reunify Taiwan, and reunify is his word. He will have to invade Taiwan and take all of the people in Taiwan against their will, if you look at the polling there. And so when you read the Director of National Intelligence's report that in the US, we have 16 primary intelligence agencies. The Director of National Intelligence synthesizes a report to Congress. So there's a classified report and then there's an unclassified. The unclassified is released in March of each year. Govind, if you take the time to read that report, you see that there is no question that China single-handedly represents the largest risk to the U.S. national security and to the national security in the West. And so when you ask why I care so much, if you look at the world the way it sits today, you have a ground war in Europe between Russia and Ukraine. You have a war between Iran and its proxies in Israel. And you have a coming war with Taiwan, China, and maybe Japan, Australia, US in the South China Sea. And so why does it matter? It'd be like asking, why does Hitler matter in 1936? And I say that not to compare Xi Jinping to Hitler, but to compare him in one aspect. These people, Putin, Xi, they are authoritarian madmen. They don't operate democratically. They don't care about their people. They care about their power. And so I believe China and Xi Jinping is the largest risk to our way of life going forward.
And if I were to come back to trade, now the linkages or the interlinkages between the United States and China are obviously very high. Even in the case of DeepSeek, the $6 million or allegedly $6 million AI project has been greeted favorably by CEOs, including the tech CEOs in America, and it's seemingly including by President Trump himself. So there seems to be a constant current of mutual benefit running at all times.
Yeah, I mean, first of all, the $6 million, as you know, it's a fabrication. It's a claim that's made by, let me get this right, some hedge fund kid who had a side hustle where he thought he could develop the world's best large language model and AI program. I mean, come on, Govind. Now, just the actual claim is so ridiculous that I'm surprised that everybody bought it. Like, it's so obvious what they do and what they're doing here. And when you look at Microsoft and you look at the investigative authorities in the US, we saw huge amounts of ChatGPT, OpenAI's source code going to China in October. So you have an entire edifice of the Chinese Communist Party in a race both for AI and quantum. And we all know that race has to be won by the West and not by China because, we don't need to get into that if you don't want to. But the bottom line is there were hundreds of billions of dollars spent to get OpenAI to where it is. And if you look at Google, Meta, and Amazon's announced capital expenditures for AI for 2025, between 60 and 80 billion each, so call it 210 billion, will be $2025 spent on AI. There is no Chinese hedge fund manager side hustle at 6 million that is doing anything meaningful. Can they make something a little bit better if you give them the corpus or the body of the work that you've done so far? Well, of course they can, right? But $6 million didn't create this and it won't. And I think it's vital to understand that China itself has said, the Communist Party has said they're going to spend about $135 billion state spending supporting AI research in China this year. So which one is it? Did you spend $6 million in a side hustle and create the greatest AI program in the world? Or are you going to spend 135 billion supporting AI in your country this year? I mean, again, their own actions contradict their own statements.
And you're saying that this is symptomatic of something larger and has been happening for a while.
Let me equate it to how China operates in various world markets, because you want to talk about trade. You want to talk about how they operate. Let's look at rare earth metals. They have 97% of the world's finishing capacity for rare earth metals. So geographically, they don't have all of the rare earth metal deposits, but they have all of the finishing. They control rare earth minerals. Rare earth minerals are very important in a number of defense applications as well as practical and commercial applications. So they also hold the price of all of these finished goods down in the world markets enough to where US businesses can't spin up, comprise some finishing capacity and finish it and make any money. They keep the global price below where we could make money. Therefore, they keep global supply and they keep control. Whether you look at rare earth minerals, whether you look at aluminum, whether you look at synthetic graphite, I can go on and on and on. The playbook is the same. So when you think about the DeepSeek psychological operation, which is what they launched, what they're trying to do is get people to maybe stop for a second or even attenuate their capital investment in AI. Because if they say, well, it only took $6 million and it's going to be free, and you guys charge $200 a month or $300 a month, what they're trying to do is stop or severely reduce US investment in this arena. And that was their objective with this DeepSeek operation.
Right. So I'm trying to link all of this obviously to financial markets and capital markets. So a step back question first. Till Donald Trump was elected president, the markets were running up. And I'm talking about Wall Street now in anticipation and in some ways having also concluded that he was going to come back, and he did. So after which I think the markets seem to be a little more stable and now there is uncertainty. So how are you seeing this whole period of financial market behavior?
I mean, we are still within 1.5% of the all-time highs. We are materially higher than when Donald Trump won the election. Are there some things we're going to have to do to change? The tectonic plates of the world are going to have to change a bit. And they're going to have to change because the prior administration was trying to build a regulatory superpower, very much like Europe, which, Robin, we know where Europe's gone in the last 20 years. It's gone nowhere. Europe has become a regulatory superpower where they've run out all of the innovative talent and they continue to do so. And so I don't know if you've been to America since the election, the buzz and the enthusiasm and the business expectations, I've actually never felt them greater or higher than they are right now. The business world believes that our country actually is going to stop being a regulatory superpower. You know, people like Lena Khan at the FTC, and we can go through department by department, but America was stifled. We were growing, but we were growing despite the fact that we had people at the top trying to restrain and stop some of these business practices. But in the end, we're going to go back to traditional antitrust analysis. We are going to lessen regulation, and we are going to kind of ignite those capitalistic fires that must be lit to get our country to move forward. Because as you know, we're not going to pay down our debts. So we're not going to be able to move the numerator. What we've got to do is grow the denominator. We need to grow GDP. And when you see what Scott Bessent's objectives are in the Treasury and what the Trump administration has elucidated so far, we will grow our GDP, I think, faster than people think we will.
If I were to drill that down a little further, and you mentioned the FTC, so maybe if I can ask you to illustrate that. So does that mean telecom companies will be freer to grow? And of course, my subsequent questions would be to do with if they grow, then how and what could that mean for the rest of the world? But are there any other examples that you can quote where you felt that there was stifling regulation and therefore things could change now?
Yeah, I mean, look, let's just say the news over the weekend is how Elon Musk's Doge team is in the US aid offices and are focused there. When you understand what the prior administration was doing around the globe, the reason Musk is in Doge is when you walk in the front door, there was an LGBTQ plus sign. There was a sign about diversity, equity, inclusion. They were spending hundreds of billions of dollars in pushing these narratives of multiple genders and diversity, equity, inclusion at the top to our embassies in other countries around the world. I don't know if India felt this, but we pushed this as LGBTQ plus platform into Roman Catholic countries thinking we could change them. And we became the laughing stock of the world. And that became a priority of the United States. So we are going to deprioritize the crazy things that we were doing in the last 4 years, and we're going to focus on business. As it relates to Lina Khan and telecom growth, or let's just say M&A, an example, I'll give you a perfect example. So any hydrocarbon mergers, because they also had a very large green agenda. As you know, I'm an environmentalist. I'm sitting here in the middle of a forest talking to you, believe it or not. Uh, I manage a conservation-based fund, and those two things can exist at the same time. You have to have clean burning hydrocarbon growth. You have to focus on LNG and natural gas, which only has two byproducts, CO2 and water. That needs to proliferate around the world, especially in the world's island nations, in my opinion. But Lina Khan and the FTC were telling every single CEO, buyer and seller in that space that she's not going to let mergers through. She's going to challenge these mergers. And I'll give you an example. EQT, one of the big energy companies in America that is focused on paying dividends with upstream company, they buy upstream and they turn it into an MLP and they pay dividends, was buying a company called Tug Hill. It was a Marcellus play. Marcellus is up in the Pennsylvania area of the United States. It's where there's a heavy natural gas presence. So EQT owned 6% of the Marcellus shale. Tug Hill owned a little less than 1%. So when you're doing traditional antitrust analysis, Govind, if a 6% owner is buying a 1% owner and creating a 7, and there are many other players there, and it doesn't create a monopoly, it doesn't create any, like traditional antitrust analysis, this wouldn't even have made the conversation. And she filed to block that. And she did really underhanded things when she was blocking that. So I'll give you an example on process. So the FTC has 5 commissioners. There are rules about open records and FOIA-able records. So when you go state your case or make your case at the FTC, typically you see 3 to 5 of the commissioners in your hearing. And if there are 3 commissioners in there, so if there's a majority, every single comment, every statement, every video is now a matter of public record. So when she was blocking these mergers, her legal counsel instructed the 5-member board that when they're meeting with the companies that they're blocking, that they should meet with them individually so that nothing can be discovered. So when Tug Hill was making its case to the FTC about this blocking being absolutely insane and having no basis in the legal, let's say, structure of the United States, they were forced to go meet with one and one and one. And if they meet with them in separate meetings, then nothing's an open record. So what I'm telling you is they played dirty, they played illegally, and they filed to block things. And in this case, for an example, this began as a $5.3 billion merger between these two players, or an acquisition of $5.3 billion. It ended up costing the seller $500 million and then $85 million in legal fees, and it took an extra 18 months. Imagine if you knew that any possible combination was going to cost you almost $100 million in legal fees and take you 18 months of your time, you might not even enter into the agreement. And that was the idea. The idea was to stifle any kind of M&A. So what you're going to see going forward, again, we do have laws in our country. We do have a basis for those laws, go all the way back to the Sherman Antitrust Act, but we're going to go back to a proper legal basis for challenge. Do I think we should challenge mergers? Absolutely we should, especially if it's number one buying number 4 to make number 1 an even bigger monopoly. Well, we should block that. But if it's 6% buying a 1% and no one has a monopoly, then it shouldn't even play, is what I'm telling you. So Lina Khan was a menace to U.S. business.
Right. So I'm assuming that you're saying in the new administration or the current administration, things should be freer for companies, businesses, and their CEOs to expand, to grow. How is this likely to play out on Wall Street? And if I could come to how or what kind of themes that you would look at now as an investor, first on Wall Street and then in the rest of the world, to the extent that you do look at the rest of the world?
This is going to sound like it's that I'm pandering to you, but I'm not pandering to you. I would just say that I wouldn't invest anywhere other than America or India. When I look at India, India has a very favorable population dynamics. I think that if India finds its way through its relationship with Russia and more into the Western world, India is a very exciting place. As China's belligerence or malevolence rears its ugly head more and more, as you know, Apple has moved a huge portion assembly from China to India. I think India should be the net beneficiary of all of the troubles in the world with China. So I think that India has a lot going for it. When I think about America, I'm very positive about America. When you think about where we stand, we use American dollars or US dollars for everything that we purchase. We have all of the protections of the US legal system. And when you look at the way the capital markets are set up, we're 4% of the world's population, we're 25% of the world's GDP, but we're 60% of the world's capital markets. So people feel safe here. And if you look at the rest of the emerging world, you look at the architecture of their markets and the inflation that we just pushed to the world in the last 4 years. You and I both know we pushed 40 to 50% inflation to the world. There's a negative convexity. There's a level of things get worse for an emerging economy that isn't America, meaning the financial architecture of emerging markets is more brittle than that of developed markets. And when we push that kind of inflation to the world, you can break these countries. So when you look at the hyperinflation that happened in Argentina, the hyperinflation that happened start choosing countries in the Middle East, Lebanon, Iran, Pakistan. You look at, we destabilized all of those regions. And so I don't believe that investing in emerging markets is a good idea right now. I believe sticking with developed countries with positive population demographic trends and strong legal systems is the right thing to do. So when I think about asset allocation, I'm going to focus here. And if those people that want an international component, places like India are fine. Places like Australia are fine, although they're proximate to China. There are a few pockets of developed countries to invest in, but I would not be investing in emerging markets now because I believe geopolitically, the world is on a path that is not going to get any better anytime soon.
This is just for those who listen to this. How are you distinguishing or defining emerging markets, and what kind of countries do you usually put in that basket?
So I'm not talking about Africa or frontier markets. I'm talking about, when I think emerging markets, I think Southeast Asia and I think South America. That's the best way to put it.
So when you say Southeast Asia, you mean Indonesia, Malaysia?
Yeah, I'm thinking Indonesia, Malaysia, Thailand, Vietnam, Philippines, those areas, because those areas also they need US dollars. They need a US influence. Again, the reason China's pushing so hard in Scarborough Shoal and down in the Sabine Shoal and all of the places where it's pushing right off the coast of the Philippines, because they are trying to create their whole sphere of force projection and kind of rule Southeast Asia with an iron fist. So I think we as democracies need to be investing in those nations so that they can stand on their own 2 feet. So maybe even ideologically, I'm interested in investment there once we can fix things. I mean, you look at the Philippines. China owns 40% of the Philippines electric grid, and they own the software that manages the grid. So the Philippines have a hard time pushing back against China right now. And, they're a U.S. treaty ally. We've had a mutual defense treaty with them since 1951. And they're reluctant to engage in that and ask for our help because they know their electric grid will go down. I mean, there are some really bad situations in the world today that we need to fix.
And just to come back to India, and when you look at India, as in when you do, what's the basket that India usually sits in from your point of view?
I think what I'm doing is, you were asking me where I think in the longer run, from a macro perspective, there would kind of positive asset allocation from US investment. I think India is a large enough economy. I think of India as a developed economy, maybe a little lesser developed than other developed economies, but I don't think about India as an emerging market. I think about it as, there is huge technological capability in India. They are, again, we've been doing a lot of outreach with you, as I'm sure as you probably know. Your ambassador has done tours around the United States. They've done a great job with the consulates that you've got set up and really trying to get U.S. businesses to partner with Indian businesses. The outreach has been pretty substantial in the last 24 months. So when I think about where India fits, I think India fits in a portfolio that is looking for international diversification in a period of time in which that diversification should be severely reduced due to the conflicts around the world and the coming conflicts in the next few years.
So that's at the country level. Are there specific sector themes that you're focused on, and particularly, let's say, in 2025, or given everything else that's been happening around? Because you talked about, you touched upon phones in a slightly different context, electronics, or we talked about minerals, we've talked about oil and gas. So are there any specific themes that are interesting you right now?
That's a great question. At our firm, we launched a business that specifically does lending to defense technology companies. You probably know, if you look at the venture capital league tables and you look at where the capital in VC has been flowing, you know, overwhelmingly that has been flowing into AI, and AI is a very large bucket. As you know, it's almost like .com was back in the first run. Everything, of course, has some AI to it. So I know that needs to be differentiated, but you take AI and then you look at the second bucket, and the second bucket is defense. You've seen enormous amount of capital moving into specialized defense connect. That is something that's absolutely necessary because, Govind, you know, the next wars that are fought, as we've seen in Ukraine, as we've seen in Israel, Iran, there's a lot of cyber that goes on, right? There's a lot of electronic warfare that's going on the battlefield, with Russia being able to neutralize GPS, make it unusable. So a lot of these defense tech companies are figuring out how to fly without GPS. In fact, I hosted this weekend, where we're sitting here, some of the top defense tech companies in America, along with some of America's top warfighters in our military. And we got together, and you think about historically that life cycle of programs of record for the Defense Department take 10 years. They literally take 10 years to get going as a official program of record. Well, the world has been innovating much quicker than that. And if we're going to be effective as a deterrent in our warfighting, we better figure out how to get programs of record in less than a year. And so that's a lot of the talk. So we've been lending to some very interesting defense tech companies. And I think that is, when you look at what the US is spending as a percentage of GDP, we're spending 2.9% of GDP on defense. During the Cold War period, we spent on average about 6% of GDP. During the Vietnam, Korean Wars, it was 10, 11% of GDP. And at the back end of World War II, 1945, we spent more than 40% of our GDP on defense because we had to win. So I think you're going to see macro winds change, where you're going to see a lot of the glass of the system is going to get broken that has existed for the last several decades. And there's going to be a new procurement process and a new adoption process of some of the most interesting defense tech. And Govind, one of the most important things that I've seen in the last 2 years, digital manufacturing. So we all know about 3D printers and how important they can be for very specialized parts, but they can also print end-to-end now a Predator drone that historically might have taken 4 or 5 months to make. They can make one every 2 days now. It used to have 28 parts. Now they can print it in 4 parts. You can literally see the evolution of digital manufacturing in the United States is here. So what you're going to read about in the next 2 years is how the US is going to have a renaissance in manufacturing, which is something that not a lot of people are ready for. But I've been to a few of these factories recently, and I leave there with the hair standing up on my neck. It's some of the most amazing things I've ever seen in my life. So that's something to be and if you think about how that process, well, let's say now some of it's for aerospace and defense so that we can catch up on munitions and deterrence, but it permeates the rest of the world's manufacturing, whether it goes from automobiles, chassis, brakes, and things like that, or even engines, to other manufacturing around the world. So I think you're going to see a digital manufacturing revolution in the next few years, and very little's been written about that. So that's an exciting thing to look at. And India should have its part there because you have such an amazing brain trust of intellectual capacity that this is something that could be, I don't want to say easily adopted, but it should be adopted.
Kyle, it's been a pleasure speaking with you. Thank you so much for joining me.
Yeah, you too. It's a pleasure to meet.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.